Welcome on board, Gautam Duggad, Head of Research Institutional Equities at Motilal Oswal Financial Services, and highlight what he's made of the earnings so far. Gautam, hi, morning. Great to have you on the show as always. Gautam, clearly, one has seen that metals and oil and gas are the ones which have sort of powered the earnings this quarter. But I'm wondering how sustainable is this commodity-led boon which the markets have seen so far?
Hi, Aisha. Good morning. Thanks for having me. Yes, metals and oil and gas have clearly provided an additional kicker to the earnings, but even otherwise, the earnings have been fairly healthy. I mean, if you look at a headline basis for our coverage universe of 345 stocks for which we projected earnings, the earnings growth stood at 16%. But even X of metals and oil and gas, the numbers were slightly better at 12%. Right. So this is now the sixth quarter high earnings growth, and progressively we've kept on increasing the growth numbers every quarter. It started at 10, then 12, then last quarter was 14, and this quarter is 16%. What is heartening is the spread of the earnings. Out of the 27 sectors we covered, 19 have delivered double-digit earnings. So this is happening after almost 7-8 quarters that we have so many sectors which have contributed to the earnings growth. I mean, you had very strong earnings from coming in from auto, ex of Tata Motors. The earnings were up 23, 24%. Capital goods earnings were up 24, 25%. You had NBFC, both cohorts, lending, non-lending, doing well. In fact, lending NBFC did close to 30% earnings growth, non-lending 35%. PSU banks have beaten estimates hollow. All six banks that we cover on the PSU side, four of those six have beaten estimates, and PSU bank growth, which we are expecting to be flat at about 5-6%, it delivered 18% earnings growth. So I mean, even IT, while earnings are not relevant at the moment, everyone is discussing the AI disruption. But for the quarter, even IT earnings were up 12%. Retail did well. So across the board, we have seen sectors contributing to the earnings. And this is happening after a fairly long time. Last 5-6 quarters, Aisha, we've seen earnings getting cut and earnings being in a very flattish trajectory. This time, the other interesting thing is small caps. And we cover a fairly large number of small caps. We have a coverage of close to 160 small caps. For that, there has been a turnaround in this quarter, which we were expecting. They've posted close to 30% earnings growth after posting 0 to negative number for last 5 quarters. Even mid-caps were slightly underwhelming in my view. Ex of commodities, they were in line. But on an aggregate basis, for the 100-odd mid-caps that we covered, the growth was slightly disappointing at 15% versus our expectation of 22%. But this is largely an impact of commodities on the negative side for mid-caps. So ex commodities, even mid-caps had a 20% growth. So net, Aisha, the pace of earnings cut has also slowed down significantly. In fact, for our coverage universe, at an aggregate level, we've upgraded earnings by 0.6% for this year and close to 0.3, 0.4% for next year. It's just the Nifty where earnings have remained flattish on revision. There's been no cut and there's been no upgrade. So net, I'll take a lot of heart from this quarter's earnings season, given that the quality was far superior compared to what we've been witnessing in the recent past.
Right. Oh, indeed. The earnings really this time around have been the silver lining. And, like you rightly said, it's coming out of a long gap of 5 to 6 quarters. But I want to put earnings aside, Gautam, for a bit. And I want to talk about what the market sentiment is right now. Yes, you could blame IT. Given the dominance and the weightage that the sector itself holds. But what's leading to this pressure in the markets right now?
So, Aisha, look, there are two aspects to look at it. India has underperformed massively in the last 15, 18 months, in dollar terms more so, versus EM basket versus developed market. We are all aware of that. Second, despite the flatlining of markets for the last 18 months, the valuations are not screamingly cheap yet. Yes, for the large caps, they are in line with long period average now, which is where we are finding value. But in mid caps and small caps, you still have to be very selective. From a top-down basis, if you look at mid cap, small cap valuations in India, mid cap index is trading at 28 times, small cap index is trading at 24 times. So they are not offering any comfort on a headline basis. Yes, on a bottom-up basis, there can always be 15, 20 ideas that you can find. So that is providing a slight bit of headwind to the market. And third, every now and then some volatility keeps cropping up. Sometimes it is related to trade deals. Sometimes it is related to IT and AI related disruption. And IT is still, despite the underperformance and despite the weight having reduced by 50% in the index from 20% back in December 21 to close to 10% now, or maybe it has come down below 10 also, it still has a significant impact on the market because 10% of the index down almost 10% or 15% in the last 1 month has robbed around 1.5% of the market on a very, very simplistic calculations. So clearly, we are going still through tough times. But as focus shifts back to fundamentals and earnings, I think people will see pockets of value emerging and the narrative around India also changing because the cumulative impact of all the fiscal and monetary steps that the government and the RBI have taken in the last 12 months, be it interest rate cut, GST cuts, and even the income tax rate cut, I think the positive impact of that, those steps are now being felt, and in partly it's getting reflected in the numbers. I mean, you look at auto, consumer staple, for example, had a double-digit earnings growth. So I'm quite constructive. I know things don't change in a hurry. Pendulum has swung, and it'll take some time before things come back to normalcy. But I'm finding the overall market construct very, very favorable now.
Very, very favorable. Gautam, I have a minute to open. Let me quickly squeeze in a question. With regard to IT, where should one sit at this point? And where should valuations be? Because it's certainly disruptive in terms of the tech that's coming through.
So look, it's a tough question. I wish I knew the answer where it could settle because we upgraded IT in November thinking that what more could we lose on Infosys at 1400? And we went from underweight to overweight after 2 years. And in the next 1.5 months, Infosys was off 15-17%. And all of that has come down now, retraced in the last 15 days. It's now somewhere close to, I think, 1300. So clearly, we don't know where things will settle in the short term. What we have done, and we published an interesting report on this 2 days back, where we are looking at what is there in the price if we do.
Our discussion with Gautam. Gautam, apologies, had to address market open. But I want to talk about, Gautam, the narrow Nifty contribution that one is seeing. I mean, 5 companies contributed to 78% of the incremental Nifty earnings. You think the index is sort of masking the underlying weakness despite a headline growth?
Aisha, yes and no. The reason why it is happening is because 3 big sectors of Nifty, which is the financials, within which banks specifically, and within which private banks specifically, consumer and IT. These 3 account for roughly 60% of Nifty's profit pool. And if you look at these 3 sectors for last, I think, a few quarters now, or maybe 2-3 years, their growth has actually in the last 2 years gone very range bound in 5 to 10% band. Private banks for last 3 quarters have been very flat. This quarter also, the private bank growth is 3%. You look at consumer has been in the 5 to 7% band. This quarter was a bit of an aberration because the GST related tailwinds helped in this quarter because there was restocking in October to December. So consumer staples have grown at about 9 to 10%. And IT, obviously, because the Nifty is dominated by large cap IT. So if you look at the Nifty IT earnings growth, that is also in that 6-7% band. Now, if you have a 60% of the index, which is growing in the 5 to 10% band, clearly, whatever growth that you are seeing in Nifty at 7-8%, it will be very, very concentrated in few stocks. And which is why you see this kind of statistics where 5 to 6 stocks are driving 70 to 80% of incremental earnings. The interesting thing is the divergence between Nifty and the broader market earnings has expanded significantly. And when you look at our coverage universe of 345 stocks, where we are saying that earnings growth is 16% and Nifty earnings growth at about 7%, that basically means that the non-Nifty coverage universe that we have of about 300 odd stocks, that has grown upwards of 20%. And which is why I said that when you look at the market earnings this quarter, you're going to derive very different conclusions basis what index you look at. If you look at Nifty, it will be very humdrum, 7-8%. And of course, the projections for next year are at 16-17%. But for the quarter, it is very, very tepid. However, if you look at the broader market indices, the picture that you will get is very different at about 16% for our coverage. And I'm guessing our coverage broadly represents Nifty 500 now. The convergence is very, very direct now. So you will see Nifty 500 also roughly translating into about 15-16% earnings growth. And then if you dive deeper, and which is where the job of an asset allocator or a capital allocator becomes slightly more interesting, because you have a lot of opportunities now in the mid segment where valuations have corrected. There's been a time correction. And in some pockets, the earnings are holding up very strong. In our report, we've given 10 mid, small, and large cap ideas where the earnings for the quarter have been extremely strong. So that's why I said it's a market which, while it sounds cliche to say, but genuinely a stock picker's market.
Point taken, Gautam. Two pieces from whatever you suggested. One was that on the large cap end, there was some bit of softness to the numbers versus the mid and the small. How much do you think of that is an attribution to the labor code impact? Because that adjustment was one of the reasons why profitability wasn't as strong as maybe the kind of EBITDA growth that we saw, Gautam. So that's the first part of my question. Second
So
part.
just to close that statistically right away, we've taken labor code related changes as a one-off, right? So that has not impacted the analysis that we've done on a YOY basis. We've taken all those costs as a one-off. So when we say 16% earnings growth for coverage or 7% for Nifty, that is by stripping out of that one-off component of labor code impact for the quarter.
And Gautam, talk to us about whether this quarter gives you the comfort as to whether a larger upgrade cycle, earnings upgrade cycle could well kick through. And if so, what could the timing and what could the factors be to watch out for a likely upgrade cycle?
Oh, if I wish that could be the case. For now, I'll be happy that there are no downgrades. Look, we've had a very strong 5 years of earnings upcycle between FY20 to FY25 almost, or maybe 24, when your earnings compounded at 20% plus for Nifty and close to 25% for Nifty 500. There was no year of an earnings downgrade in that 5-year period. And you, in fact, actually had 2 years of earnings upgrade. Then happened FY25 and FY26, where we saw a fairly elongated earnings downgrade cycle. Even after the growth that we're talking about in FY26 at about 7-8% for Nifty, and on a full year basis also for our coverage 15%, the EPS that we are getting for FY26 Nifty is still lesser than what we had projected for FY25 2 years back, right? So in April 2024, we had projected 1142 rupees of EPS for FY25. Now in FY26 also that is not happening. So our earnings cycle got pushed back by almost 1.5 to 2 years. For now, I am happy and content that there are no material earnings downgrade which are happening. At the margin, there are upgrades, but they're still in a 0.4, 0.5% bracket. So let's see, how we progress in the rest of the year. Very important thing to notice for any earnings upgrade cycle to begin, the financials need to have a very strong contribution because they're still 36-37% of the total profit pool, and which is where things have become a bit more soft, largely on the private bank side in the last 2 years. Now, that is where we are expecting a bit of a turnaround. Our expectations for private bank earnings on the next 2-year basis is close to 20% CAGR. Now, if that comes through, I have fairly strong confidence that even Nifty will be able to deliver around 14% earnings CAGR that we are penciling in right now, close to 16% for this year, that is FY27, and about 12 to 13% for FY28. But we'll have to see because things are changing very rapidly. The data point which keeps coming up very interesting. You just saw the credit data for the last fortnight of January. It's touching almost 15%. So that is giving some solace. Of course, as I mentioned to Aisha in the earlier part of the interview, the benefits of the monetary and fiscal steps that the government and RBI has already taken, they are now manifesting in the numbers. So clearly, the narrative around earnings will keep changing as we move forward. This is the first quarter where the earnings picture has looked so brighter in the last 1.5 years.
So basis these earnings, Gautam, and I know you have to run by 9:30, so we'll keep it short. What are your preferred sector calls?
So Aisha, very clearly, we are overweight, and it's been a preference for us for some time now is automobile, and the auto earnings have been excellent. The monthly numbers after the earnings got over for the month of January, the auto numbers were very strong. So we like that as a sector. We are overweight. We are overweight on PSU Bank, and that call has played out beautifully. We still think that SBI is underpriced for the kind of quality of earnings that it is showing. I'll just give you one data point. The net NPA and the PCR of SBI is same as ICICI Bank and better than HDFC and Axis Bank. So why should it keep trading at 1.4, 1.5 times is something which beats me. But that's a discussion for some other day. You're positive on PSU Bank, that's an overweight. You're positive on diversified financials also, which is NBFC and capital market. Capital market is our preferred theme from a 3 to 5 year basis too. Second sector where we are very positive is consumer discretionary. We have zero allocation to consumer staples in our model portfolio. But we are very bullish on consumer discretionary names like Titan, Indian Hotels, Radico Khaitan, Indigo is something which we like. And then, selectively, we like capex plays on the defense side, on the EMS side, which is our big overweight call again. And then we are neutral on telecom, cement, pharmaceuticals, and underweight on metals, oil and gas, and consumer staples. In fact, private bank is also marginally underweight for us because we don't have any small cap, mid cap private banks in our model portfolio. So that's our overall portfolio construction as we stand today.
Does that at all change, Gautam, if FIs were to start coming back in a meaningful fashion, if that FI flow were to reverse?
Honestly, I don't change my sectoral positioning basis the direction of the flows. Sorry, I forgot to mention to Aisha on our question, we are also positive and we currently have an overweight call on IT, which we discussed at the beginning of the show. So that's another call, which is last 15 days not worked, but we are quite positive because they're now reflecting a terminal growth of just 3%, underlying free cash flow implied FCFC CAGR of just about 6.5%, and valuations have become quite cheap. Of course, we don't know where the things will settle, so we'll wait for that. But purely on a fundamental basis, purely on valuations, yields, and other ratios, we think IT is now looking quite attractive. I know I may look foolish 2 weeks later if something else comes in on the AI side, but purely just from a fundamental perspective, it looks good. Just to complete that point, we don't change the portfolio depending on which client or which side of the fund is buying in the market or not. That doesn't determine our portfolio choices at all.
Understood. Okay, Gautam, a longer discussion perhaps next time, but great to have you on the show and get in a color on what you're thinking about earnings.
Pleasure. Thank you.